Health insurance is confusing, so let's break down everything you need to know before buying a plan in this video. Now settle in because it's going to be a long one. As always, remember to like and subscribe, and of course, if you have any questions as you're watching this video, you can reach us in the comments below or at the number on the screen. We are licensed nationwide and there is absolutely no charge for our services. Today, we're really going to go over everything you need to know for marketplace plans. Now let's start with monthly premiums. Monthly premiums are pretty easy to understand. It's the amount that you have to pay monthly to keep your insurance active. If you don't pay your monthly premium, then you're not going to have insurance. But you cannot judge a plan based on its monthly premium alone. Remember, a lower monthly premium doesn't necessarily mean a bad plan, and on the flip side, a high monthly premium doesn't necessarily mean a good plan. Make sure you compare your monthly premium with the plan's deductibles, copays and coinsurance, and out-of-pocket maximum. More on these costs later in the video. Also, make sure you look at the benefits offered and the networks, because paying less on a monthly basis is great, but not if none of your doctors or hospitals are in network, and a plan that offers a whole bunch of extra premiums is also wonderful, but if you're paying more for those fringe benefits and they're not something you're really going to use, then that plan isn't going to serve you either. Now, if you're buying a plan on the marketplace, you need to understand premium tax credits and how they apply to your monthly premium. A premium tax credit is just a tax credit paid up front, which is reflected in a discounted monthly premium. You may be eligible for a premium tax credit depending upon your income and your household size. You'll find out if you're eligible for a premium tax credit by answering a few simple questions on healthcare.gov. The next financial term you need to understand is deductible. Your deductible is the amount that you have to pay out of pocket or at full cost before your insurance plan begins to contribute to the cost share. For example, let's say your deductible is $2,000 and you have to be hospitalized. Well, you would first be responsible for whatever $2,000 of the total bill there is before your insurance begins to contribute to the cost share. Your cost sharing structure is of course outlined in the terms of your plan. So let's say your coinsurance is 25%. Well, then what would your bill be? If your hospital bill were $10,000, first you would be responsible for that full $2,000, which is your deductible. So $10,000 minus $2,000 is $8,000, and you're now responsible, based on your plan's terms in this situation, for 25% of that, which would be another $2,000, meaning your total would be your $2,000 deductible, that $2,000 worth of coinsurance for a total of $4,000. Unless, of course, your out-of-pocket maximum is less than $4,000, and we will talk about that later in the video as well. You should know that usually plans with a higher deductible have a lower monthly premium, and vice versa. Plans with a higher monthly premium will have a lower deductible. There's usually an inverse relationship there. So if you're someone with more extensive medical needs, then you may benefit from a plan with a higher monthly premium but a lower deductible. And if you're someone with more basic or lesser medical needs, then you may be able to save money by enrolling in a plan with a lower monthly premium but a higher deductible. And remember, there are many services such as preventative services and wellness care visits that are covered even prior to meeting the deductible. And these are of course part of those 10 essential benefits. Marketplace plans must offer at least the 10 essential benefits, and then you can purchase additional coverage for things like dental and vision rather inexpensively if they're not already offered by your plan. And of course, even though those 10 essential benefits are required, many plans offer additional benefits to entice beneficiaries. Now, group insurance and all plans on the marketplace must offer at least those 10 essential benefits. Now a little bit more on coinsurance and copays. These are those cost-sharing bills that you'll be responsible for once you've met your deductible. A copay is a fixed amount. For example, in your plan, it might cost a $25 copay to see your doctor, a $50 copay for an urgent care, and a $250 copay to visit the ER. Those amounts are fixed. They're not going to change. Coinsurance is a variable amount. So using the example we just discussed, your coinsurance might be 25% for inpatient care. That means 25% of the total cost. So it might be more if the service is more expensive. Now, if you've seen metal tiers on the marketplace, these metal tiers actually have to do with coinsurance or the cost sharing structure. Now, a common misconception is that the metal tiers are indicative of the plan's quality, and that is not at all true. It has nothing to do with the networks or benefits offered. It's really just about that cost-sharing structure. There are 4 metal tiers: bronze, silver, gold, and platinum. And generally speaking, it breaks down that a bronze plan will have a 60-40 split, meaning that your insurance carrier will pay 60% and your coinsurance is 40. A silver is a 70-30 split, a gold an 80-20, and platinum 90-10. Now, usually as you move from bronze towards platinum, you'll notice those premiums increasing because that amount is usually made up in the cost-sharing structure. So usually, again, you'll notice platinum plans on the more expensive side as far as your premiums are concerned, bronze plans on the less expensive side as far as your premiums are concerned. So just like when we were talking about deductibles, if you're someone who maybe doesn't use their insurance as frequently, perhaps a bronze or a silver plan is the way to go. If you're someone with more extensive medical needs, then you might want to look at a gold or a platinum plan. Also, if you're eligible for premium tax credits, there are extra savings available with silver plans specifically. Another term you should be familiar with is the out-of-pocket maximum. This is the maximum that you can be billed during a plan's calendar year for your medical services. So let's go back to our earlier example. Remember, we said that our deductible was $2,000, our coinsurance was 25%, and then that total hospital bill was $10,000. So we came to our portion of the hospital bill being $4,000. Now that is unless your out-of-pocket maximum is less than $4,000. So let's say your out-of-pocket maximum was actually $3,000. Well, even though ordinarily your portion of the bill would be $4,000, since your out-of-pocket max is capped at $3,000, you would only be responsible for $3,000. And if you had to be hospitalized or receive medical care again during that plan's calendar year, if you've already met your out-of-pocket maximum, which in our example we have, there wouldn't be any more bills for the remaining plan year. So, if you have a planned medical procedure, then you might want to plan for it in the beginning of your plan's calendar year to hopefully get you closer to that out-of-pocket maximum. Unless, of course, you've already met your out-of-pocket maximum for the year, in which case you definitely want to get that procedure in before your out-of-pocket maximum resets. Now, one of the most basic decisions you need to make when enrolling in a marketplace plan is choosing between an HMO, an EPO, or a PPO, which will give you maximum flexibility, especially if you're looking to travel. Generally speaking, we're only going to find HMOs and EPOs on the marketplace. Some more acronyms you may hear tossed around are HD, HP, and HSA. An HDHP is a high deductible health plan. We've sort of already discussed this earlier in the video. This basically just means that you have a higher deductible and you will have to pay a larger amount out of pocket until your insurance begins to contribute to the cost share. These types of plans may be popular for people with more limited medical needs looking to take advantage of those lower monthly premiums, or people with truly extensive medical needs who know that they are going to hit that deductible and possibly even their out-of-pocket max very, very early in their plan's calendar year. But what I want to talk about right now is the other reason that these plans may be popular. And those are for people who have interest in HSAs, which are health savings accounts. And that's because HSAs as a benefit are only available with high deductible health plans, or HDHPs. HSAs offer a triple tax advantage, and that's why they're so very popular. Basically, an HSA is an account and it's your money. The amount that you contribute is pre-tax, therefore lowering your taxable income. The account itself is interest-bearing, and that interest is not taxed. You can even invest up to a certain portion of your HSA, and the earnings on those investments are also not taxable. Now, as long as you withdraw the funds for a qualified medical expense, there's no penalty of any kind. You can also continue to let the account roll over from year to year because, as I said, it's your money. And if you hold on to it until you turn 65, well, then you can use it as a basic retirement account. A final type of plan available on the marketplace are catastrophic coverage plans. Now, these plans are really only available to those who are under 30 or who are able to apply for a hardship exemption. They're a type of bare bones high deductible plan. Now, with the catastrophic coverage plan on the marketplace, you will have a high deductible, probably a high out-of-pocket maximum, but you'll have a pretty low monthly premium and you'll still be able to access your primary care physician at least 3 times a year. So these are good for people who definitely want to save money on their plan, and especially for those who may be ineligible for a premium tax credit. Because if you are eligible for a premium tax credit, you can't apply it to a catastrophic coverage plan on the marketplace. If that's the case, you still might be better served with a more traditional marketplace plan. There are other types of insurance plans available, things like hospital indemnity insurance or critical illness plans, as well as insurance alternatives, things like direct primary care or even health sharing ministries, and we will talk about those in other videos, so make sure to subscribe to stay up to date, and please, of course, like this video so that we can get this information out there. As always, if you have questions, you can reach us in the comments below and at the number on the screen. And of course, there is no charge for our services, which is one more thing you definitely want to learn about marketplace plans, is that you can use a broker. You do not have to do it by yourself. And for many brokers, there's no separate charge, there's no charge for our services. You just have the benefit of working with someone who's an expert in their field as opposed to having to go it completely by yourself. As always, thank you so much for watching and have a wonderful day. Bye-bye. Make sure to check out this video if you want to learn more about marketplace plans for 2024. And of course, please make sure to like and subscribe to stay up to date. Thank you so much for watching. Bye-bye.